Hi, this is a solution to the written exam paper, ELKA, second semester. First question, it is price elasticity, and the definition is a change in volume divided by a change in price. And it is on the price of 800, so you can see here that the change in volume is 250. On the basis of 2,500, it's a minus of 10%. So if you increase price from 50 from 800 to 850, then it is a change, a plus of 6.25 in the price. That means that the price elasticity is minus 10% divided by 6.25%. It is minus 1.6. That means it is an elastic product. Okay, and next question, it is the optimum price. We have here the price VAT included. It is 1,000, and we have the volume, and then we can deduct the VAT. And as you can see here, you do that by multiplying by 0.8. Danish VAT is 25%, but if you have an amount with VAT included, you should only remove 20% to have the amount without VAT. And then the variable cost per unit, it's proportional, it's 400, no matter how much you are producing or selling. So then you can calculate the total variable cost here. And when you have the total variable cost and you calculate the total revenue, it is volume multiplied by the price without VAT. Then you have your revenue here, and then you can say revenue minus variable cost. It is your contribution margin here. And then you calculate the whole way through, and the optimum price is in this case 900. It gives us the company the highest contribution margin, 640. So it is the solution. And then you can read yourself here the other answers. And then there's a question about full costs plus pricing and retrograde calculation, where when it comes to the retrograde calculation, you can find out how much you maximum can pay your supplier, because you have a fixed sales price that you cannot exceed. The next thing is a question about trade receivables. You have a turnover, it's the assumption, 5.25. And then you have, for the moment, 2 months of credit plus current month. Current month, it is 15 days in average. So if you have 2 months plus current month, we call it 75 days, because that's the average. And if you divide 75 days into 360, you have a turnover of 4.8. And then you can take your turnover here and divide by the turnover rate, and then you have your trade receivables if you give them these payment conditions, 1.093. And then the question is, what will happen if you change the payment condition to 30 days? 30 days, it is a turnover rate of 12. So you can take here your turnover and divide by 12, and then you have 437. So the difference is 666. If you change the payment conditions from this one to this one, your trade receivables will decrease from this one to this one. That means the difference is this one. That was all.